Welcome to this lecture on personal finance, focusing on essential investment concepts. We'll explore how to build wealth, achieve financial goals, and protect against inflation through smart investing. Our learning objectives include understanding basic investment principles, risk-return relationships, and various investment choices. We will also recognize the importance of diversification and time horizons in successful investing. Investing is the process of committing money to assets with the expectation of earning a return over time. It's a fundamental strategy for wealth creation and financial security. Investment decisions involve balancing potential returns with the risks of loss. Generally, higher expected returns come with higher risks, a concept known as the risk-return trade-off. There are several types of investment risk, including market risk, where investment values fluctuate due to market conditions. Inflation risk means purchasing power declines if returns don't keep pace with inflation. Interest rate risk causes bond values to fall when interest rates rise, and liquidity risk is the difficulty of converting an investment into cash quickly without loss. For example, stocks generally offer higher potential returns but greater short-term volatility, while treasury bonds provide lower returns but greater stability. Successful investing follows key principles that guide decision-making and reduce mistakes. These core principles are crucial for long-term financial success. One key principle is to start early, as time allows compound growth to work in your favor. The earlier you begin, the more significant the impact of compounding. Another principle is to diversify, spreading investments across various asset classes to reduce risk. This helps to cushion your portfolio against market fluctuations. Investing consistently means contributing regularly, regardless of market cycles. This disciplined approach helps average out your purchase price over time. Finally, avoid speculation and focus on long-term goals, not short-term trading. Patience and a long-term perspective are vital for investment success. For instance, investing $200 monthly at a 7% annual return for 30 years yields about $226,700. Waiting 10 years to start reduces the total to roughly $108,000. Let's move on to the types of investments available. Investors can choose from many asset types based on their goals, risk tolerance, and time horizon. Stocks, or equities, represent ownership shares in companies. They offer growth potential but come with high volatility. Bonds, or fixed income, are essentially loans to governments or corporations that pay interest. They return the principal at maturity. Mutual funds pool money managed by professionals, offering instant diversification across many securities. Exchange-traded funds are similar to mutual funds, but trade on exchanges like stocks throughout the day, often with lower fees. Real estate provides both income through rents and potential appreciation. This can include direct property ownership or real estate investment trusts, known as REITs. Commodities are physical goods like gold, oil, or agricultural products. Cash and equivalents are low risk. Liquid assets such as savings accounts and treasury bills. A balanced portfolio might include 60% stocks, 30% bonds, and 10% cash, depending on your age and risk tolerance. This allocation is key to managing risk. Diversification and asset allocation are crucial for reducing risk by spreading investments across different asset classes and sectors. A diversified portfolio smooths returns. During a market downturn, bond prices often rise, offsetting stock losses. This counter-cyclical behavior helps stabilize a diversified portfolio. Asset allocation guidelines suggest younger investors favor higher stock allocation, perhaps 80% stocks and 20% bonds due to a longer time horizon. Conversely, investors nearing retirement often prefer a higher bond allocation, such as 40% stocks and 60% bonds, for greater stability and income. The time value of money and compounding are powerful concepts in investing. Compounding allows your earnings to generate further earnings. Investing benefits from compound growth, earning returns on both the initial investment and accumulated interest. This exponential growth is a cornerstone of long-term wealth building. For example, investing $5,000 at a 6% annual return for 20 years grows to $16,035. This demonstrates the significant impact of time and consistent returns. In summary, understanding different investment types and managing risk through diversification is essential for long-term financial success. Key takeaways include recognizing that all investments involve risk, so know your tolerance and goals. Diversify to balance potential returns and volatility. Finally, begin early and stay consistent to benefit from compounding. These principles will guide you toward achieving your financial aspirations. Thank you for watching our lecture on personal finance, focusing on essential investment concepts. See you at the next lecture.